The US stock market, yes, I think we'll be at 6,000 to 6,100, could even be as high as 6,300 by the end of the year. And there's some technical reasons for that. Once we get through the election, um, we just formed a cup and handle pattern technically in the markets and just broke out of that pattern. That's a fairly bullish pattern. And a target for that completion of a breakout of a cup and handle technical pattern is somewhere between 6,000 and 6,300.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart, welcoming you back here at the end of another week, joined as usual by my good and stimulating friend, portfolio manager Lance Roberts. How you doing, Lance?
I'm okay. It's Friday and end of the week. It's been quite a week, so yeah, but all good.
All right, good. Well, look, I chose stimulating because there is a lot of easing, and in the case of China, a lot of stimulus going on now in a number of large economies around the world. So I want to talk with you about the repercussions of all that. Um, Maybe if we can, you weren't on the channel last week because you were doing me a solid, and we were doing a live event for Substack because they were launching a new live stream service.
Yeah,
So we
and
kind of did our
somehow now I have a Substack account, so now I'm happy to post to that since you got it started.
I know. I've been getting your Substacks this week, which, by the way, folks, if you want to get Lance's written thoughts as he pushes them straight off the press, going to Substack's not a bad place to get that now. Um, but with your partner, Mike Leibowitz, who sat here in your stead, we kind of reacted in relatively real time to the Fed's 50 basis point cut, which again, you and I talked a bit about last week on Substack, but we didn't talk about it here.
Right.
So real quick, I just want to kind of do a quick recap in terms of any key takeaways that you have in terms of the implications of the cut and really the pivot. And this is the first action of the Fed pivoting policy from a tight monetary policy to now an easing one. And the Fed has basically said there's more cuts coming. Um, and while you start reacting there, I want to pull up a table in a recent piece that you put out that is interesting because it compares when the Fed cuts rates, when markets are at all-time highs, what happens next? And I think that'll be of great interest to folks. But anyways, what are some of your key takeaways
Yes.
from this cut?
Right. So two things really, and there's a chart that goes along with that table, and it was interesting because I did an interview with Charles Payne on Fox Business, and we had the same discussion. There's a lot of commentary out right now that suggests that the Fed's cutting rates, and just real quick, everything is fine right now. Economic growth is fine, employment's fine. We're still creating positive job growth. Personal spending is okay. It's savings rates just got revised up sharply. So people, I put out a Twitter X thing this morning. I don't know what do you call it these days, Adam? Is it X? Is it Twitter?
Uh,
I'm stuck on
I think we're in the X Twitter phase, and we'll probably end up at the X, but it's hard for us Twitter dinosaurs to say it.
just don't go triple X. You got to stay with the X. Um, but so I put out a thing this morning. I said, they had this big revision up in personal savings data, which is great. I checked my bank account this morning and I didn't get an upgrade to my savings. My savings were the same balance. So, there was this big, data upgrade. But, how that actually, goes into the economy is different. But remember, we had those two negative quarters of GDP back in 2023. And everybody's like, oh, see, there's the recession, two negative quarters. Well, that all was revised away. Adam, you and I talked about, and I wrote about the big gap between gross domestic income and gross domestic product. And
Mhm.
you have very big gaps in GDI versus GDP, then that's normally been pre-recessionary. Well, that was all revised away. There is no gap anymore. So, it's challenging when we start talking about Fed rate cuts. So I'm going to answer your question. I know it's a little bit long-winded, but I'm
No,
going to
no,
answer
it's good context. Keep going.
because it is. It's very important. The context is very important. So, you know, it's important to understand that historically, when the Fed has cut rates, there has always been an event of some sort. Now, again, a lot of economists right now talking about, oh, this is like 1995, where we had a soft landing. In other words, you didn't have the Fed cut rates, but you didn't have a recession. And that's a very true statement. However, right, a lot of other things are occurring historically, and this goes back to really 1915 when the Fed first started, really getting, alive and well and moving from Jekyll Island. Um, you know, every time the Fed has been doing some type of intervention in monetary policy, it's been in response to something. Something has either happened or something happens as a result of the Fed cutting rates. And again, the problem is that historically, as investors, right, we look back at the Fed rate cuts, and and I did this chart of Fed rate cuts versus the S&P 500 and overlaid all these crisis overlays over it. But when you're looking at recessions, you have to remember that recessions are dated in hindsight. So at the time that markets declined or whatever happened, we didn't know we were in a recession, just like we don't know whether or not truly we're in a recession right now or not. Now, the data certainly suggests at the moment we're not in a recession, but it doesn't mean that in 6 months, 9 months, 12 months from now, that the National Bureau of Economic Research won't come out and say, oh, yeah, actually a recession started in August of 2024. I'm not saying that's the case. I'm just,
Yep.
these occur after the fact. So yes, the Fed is cutting rates. Historically, and now you can bring up your table. Here's what's interesting about that table. So I went back and I looked at all the previous periods where the Fed cut rates. Now I used the effective Fed funds rate, that's what the market says the Fed funds rate is. The Federal Reserve has basically a low end and a high end on their target range. So they say 5.25 to 5.5. That's the range of Fed funds. The effective Fed funds rate is where it actually trades in the open markets. So I took the 3-month average of that just to slow out some of the kind of short-term volatility. And what we see is that over periods of time, there are a near-term impact to markets more often than not when you start looking at the Fed funds rate cuts, right? And generally markets tend to perform a little bit weaker. Over 12 months, markets have tended to perform okay, as long as there was not some other event. And the problem with this data is when you look at returns like this, 3 months, 6 months, 9 months, it doesn't really tell you what happened in between those periods. It also doesn't tell you what happened after that next year period. So this is a different table than I thought you were going to bring up, but this is fine.
Oh, is it? Oh, okay, because I can bring up the other one too if you like.
No, it's okay. But because I just wrote a report about Fed rate cuts and what happens next, and we can get to that in a second. But what happens is, let's talk about 1995 as the soft landing scenario, because that's what everybody's focusing on, right? There's no sign of a recession. It's like 1995. Well, the Fed cut rates in 1995 because we had a bond market crash in 1994. You had the tequila crisis or the Mexican peso crisis in 1994. So the Fed was cutting rates slightly, just kind of in response to what was going on in the bond market and with the Mexican peso. Things calmed down fairly quickly, and so the Fed really didn't need to cut rates any further. Importantly, the yield curve, in fact, we tracked 10 different yield curves, but not a single yield curve was inverted in 1995. There was no sign of economic stress or recession in 1995. In 1998, we had long-term capital management and the Asian contagion in 97, and the Fed started cutting rates. In 1998, the yield curves all inverted. In 2000, you have the dot-com crash. So this time is very, we can say, okay, this time is very similar to what happened in 1995. And yes, 12 months later, as according to this table, markets were higher. It just didn't tell you that there were problems brewing within the overall markets and the economy. It just took longer for them to show up. And they showed up in the form of the Asian contagion, long-term capital management blowing up, then the dot-com crisis in 2000. So you have to be real careful with these narratives. And again, I'm not saying you should go out and go hide in cash right now, because the markets are doing just fine. And the markets we have right now were very bullish. We just broke out to new all-time highs. So technically in the short term, it's up and away from markets, at least for now. But again, pay attention to why the Fed is cutting rates. It often and really historically has always led to some event, but it may take 9 months, 12 months, 24 months, 36 months to get there. It's a good warning sign and it's something worth paying attention to, but it's not something worth acting on today.
Okay, so just for folks that maybe are listening on a podcast and can't see this table here, essentially what it shows is that when the Fed starts cutting interest rates, when it's within 2%, the market's within 2% of all-time highs, the markets tend to perform well over the next year, right? And then Lance just went through and gave us a whole bunch of context here. And Lance, you kind of ended right where I was going to on this, which is so this shows that historically markets have liked pivots off of all-time highs, and you know, markets have been up since the Fed cut, and maybe they're going to continue to go up for a while from here. But markets react pretty much instantly to interest rate changes. Economies take a much longer time, right? So, which is sort of what you're saying here is there may be things in the system here, there may be additional shoes to drop, either from some of the slowdown that we're seeing in the economy or from the higher interest rates that have been held high for the past year plus or whatever, right? And we're not going to see any benefit to the economy the real economy, from this 50 basis point cut, probably for, let's say, a year-ish, right? And we've talked about this before too, but bringing the federal funds rate down by 50 basis points, interest rates are still relatively high given the past 10 years, right? So it's not like the Fed is all of a sudden in a regime that would be called easy. We're going to need more rate cuts before we actually get to a point where I think the economy is going to feel real true relief whenever these results are fully manifested in it. Correct?
That's right. And again, this is why it's important to pay attention to credit spreads. It's important to pay attention to markets. Markets are a leading indicator for kind of what's going on economically as well. But it doesn't mean that things can't change. So, again, everything is very bullish right now, and you need to be on that side of the ledger at the moment. But it doesn't mean that things can't change. And so we're certainly taking a look at that. So this is the chart the table I thought you were showing, which is this table. This is the table I was saying where this is the effective Fed funds rate, the decrease in the 3-month average of that, and then the number of months from that decrease to a recession. Well, you'll see that there were numerous periods where there was no recession, but the Fed was cutting rates. The problem is you were either still in a recession, just came out of a massive bear market like in 1975. 1974 was the black bear market, very sharp decline. You had Continental Illinois, you had Penn Central, Orange County bank defaults, the savings crisis. So again, every one of these times where the Fed is cutting rates, an event has shown up later. And that's why this is the chart I was talking about. If we go back and overlay, Fed rate cutting policy versus either crisis or recessions, there's always been an event. Sometimes, and again, you take a look at 1995 as a good example. We cut rates and the markets kept going up, but the problem was just delayed in coming down the road. And so I'm not saying there's not going to be a problem eventually. I don't want anybody to think that, because there is going to be a problem eventually. And again, we just go back through history. We've had a very extended, a very long bull market cycles. Secular bull market cycles tend to last on average about 15 to 18 years. We started this one in 2010, 9-ish really, but say 2010. We're in 2024. So we're 14 years into this bull market. So somewhere between 2025 and 2030, you're going to move into the next secular bear market cycle. And that will coincide with some type of event, whether it is a economic slowdown, whether it's a credit crisis type event, something, right? It could be the AI bust, 5 years from now. So again, but that's where we have to be looking down the road and understanding valuations do matter, fundamentals matter. In the long term, these things matter a lot. Valuations matter a lot. We talked about before that forward returns will be lower as we move forward. The Fed's doing a lot to try to pull forward consumption to keep the economy going, trying to delay those recessions. They've been successful in doing that since 1998. We've had very much longer periods between recessions now. So again, we're eventually going to have that problem, but again, that could be 3 years, 4 years, 5 years from now before we get there. So, you can't invest today for something that might happen 5 years from now.
Right. But I hear you saying is don't panic, but don't get complacent either. And actually, I like this chart. I'm going to probably steal this one going forward if that's okay, because
Sure.
I'll oftentimes show that just the federal funds rate on this channel, and I'll talk about the pattern here about how the Fed hikes aggressively, then hangs out, plateaus, and then essentially seems to say, oh gosh, we stayed too high for too long. And they scramble because one of those events, those crisis events, starts manifesting, right?
Yep.
It's great that you've marked that. And as I tell people, like, hey, you may have a theory that it's different this time, and that's cool. It just better be really compelling because you've got a very consistent track record that you've got a buck there. Yeah.
And look, and again, this could be different for now. Again, this is the chart of the 10 yield curves that we track. And there's two important takeaways from this. And this is why I like this chart better than just the 10-year, 2-year inversion, because sometimes you can have an inversion of one or two different yield curves, but it doesn't really manifest in anything because it wasn't affecting the whole economy. So historically, when you have 50, the red line is when you have more than 50% of the 10 yield curves inverted. And then that's not recessionary. It's recessionary when those 10 yield curves, or 50% of them, become uninverted again. So, right now we have about 80% of them inverted. So we're still not at that recessionary signal because we still haven't uninverted another 30% of the 10 yield curves. But importantly, this is 1995. And again, this is where we came out. We had the 1994 bond market crash. The Fed cut rates by 50 or 75 basis points at that point, and no recession. But you never had a yield curve inversion. This is the important part. That didn't occur until 1998. And then it wasn't until 1995 that you breached the 50% yield curve inversion that told you that you were going to have the dot-com crisis. So it was interesting because I had the conversation this morning on Twitter. This guy was saying, well, the stock market, it was up 28% before the dot-com crash, and it was up 22% before the 2008 financial. The market doesn't know anything that's going on. Yeah, actually it does, because you don't know it till hindsight, but the market was already starting to predict. They were already turning down before that crisis manifested itself both times. So yeah, the market preceded those downturns, but importantly, the credit market, as I've said before, the credit market is the only thing you need to be paying attention to. And in every one of these events, the credit market was telling you, whether it was a dot-com crash, financial crisis, even the pandemic, who would know that we were going to shut down the economy due to a pandemic? But the bond market had a clue. Now, they didn't have a clue we were going to shut down the economy, but there was a problem going on in the repo market, and the market was already on to that track. It just needed an event to really cause the downturn in equities, and that was the shutting down of the economy. But if you pay, as we've talked about so many times, don't worry about the markets, don't worry about headlines, don't worry about your thesis. Pay attention to the credit market. It tells you everything you need to know.
Okay. And so on that point, looking at the top right of the chart here, we're only about 20% of the yield curves have uninverted so far. But can we expect to see more yield curve uninversion now that the Fed is actually cutting rates?
Absolutely. No, this will all go back to zero at some point. At some point, every one of these yield curves will be uninverted.
Well, sure, over enough time. But I mean, should we
Yeah.
expect it to start coming down pretty quickly now, given the fact is now in a cutting regime, right, where it's going to be lowering the short end?
Well, the answer would be yes, but that depends on how fast they're cutting rates,
Mm-hmm.
right? And it's going to depend. So two things will depend on how fast this reversion occurs. It's how fast the Fed cuts rates on the front end, and then how long it takes for the economy to actually start registering its slowdown to a degree that starts affecting the long end to a significant degree. If you go back and look at 1980, you can see how there was a bunch of oscillation here for quite a bit of time, for about 2 years. These things were oscillating back and forth before we really got into kind of that recessionary downturn in the economy that took all the yield curves back to uninversion. So that's going to happen. It could just, and again, we're kind of chopping around up here. That could go on for another 6 months or a year before we actually see that economic deterioration to a great degree. Because don't forget, we're still cycling through a lot of monetary intervention. The Inflation Reduction Act has still got money out there, about 500 billion floating around. The CHIPS Act, we're still moving money towards Intel and everybody else to build chip plants. So that's all creating activity, and that's delaying or at least keeping the economy from slowing down faster than it probably would have otherwise.
All right, Lance. Well, look, I want to take this discussion about the Fed, which is now cutting, as we've talked about. So we've now we're now making the transition from a tightening regime to an easing regime. The ECB has already preceded the Fed in its cutting of rates. And now we have China pulling out both its monetary and fiscal bazookas. So we got a whole lot of easing, probably a whole lot of increased stimulating going on. And actually, just real quick, so folks know what's going on in China, they have been having they've been kind of in a world of hurt with their moribund economy. They're trying to do whatever they can to stoke it back to life. They had been stimulating their economy less than most other world economies over the past year, but now it seems like they're making up for lost time with a vengeance. So they've announced a bunch of rate cuts and a bunch of cuts to reserve requirements for their banking system. They have these housing market supports that they've just announced. They're going to be lowering mortgage rates, and they're going to be decreasing the amount of down payment that people need to make when they're buying a property. They've made a pledge to inject. They basically had like a 800 billion renminbi. What do you want to call that? Like a prop fund to prop up their stock market there. Basically, a slush fund we're going to use to come in and rescue when needed. And then they just announced they're injecting 142 billion US, I believe, of capital into their banks. So, I mean, they're not messing around anymore, right? Some people are saying that this is Xi's whatever it takes moment, and we'll see what's going to happen to that economy. But basically, all of a sudden now we've got the major world economies back to increasingly intervening to try to make economic conditions stimulate economic conditions. So. I'm going to talk about Japan in a second because that's going to be a little bit different. But what should we take from this? I mean, one would suspect the markets would say, okay, everybody, let's party. Not only is the Fed riding to the rescue, but so is the ECB, so is the Bank of China. Is this just time to party hard in the markets here and let's front run all this stuff and just keep driving asset prices to the moon? Or should folks slow their roll a little bit?
Well, I think it depends on kind of where you are. I would be there's Chinese equities were hugely beaten up. They've had a very massive rally here just over the course of the last couple of weeks, ever since this has started. I think this is going to be fairly short-lived. What is, the policies that they're implementing are short-term positive, but they're not going to fix the economic growth problems that they have in the economy. That's going to be a different set of policies altogether. We'll see if they get there. But yeah, in the short term, it's been a great trade. You take a look at stocks like Alibaba and others, other Chinese stocks. They just had a massive surge over the last really kind of week or so. But again, I got a lot of emails over the last couple of days, talking about, is it time to buy Chinese equities? Well, that was when nobody wanted them. As is always the case, right? The time to buy something's when nobody wants it. Now everybody can't wait to get into them. And so you've probably missed most of that trade. So I'd just be really careful with it. But I don't think this solves China's problem going forward. They've got demographic problems. They've got, economic growth problems, et cetera. We were talking about this, back in 2000, 2004, 2005. China was building entire cities that nobody was living in to stimulate economic activity and to show this economic engine that China had. But now they're playing with all the overhang of that, and that hasn't been worked through entirely yet, and I think that's going to take a bit longer and a bit different policy strategy than what they're trying to implement right now.
Probably. I mean, again, all this stuff acts with a lag too, right? So it's going to take a long time to see how much effect this has on all this stuff. They'll probably end up doing even more. But the root of the question I was asking, and again, I get the sense you don't necessarily think this is the case, but are people, would they be premature to put on their S&P 6,000 hats and say, melt up right in the near term?
No, that's different, right? So, like I said, it depends on what market you're in. China is its own animal. The U.S. stock market, yes, I think will be at 6,000 to 6,100, could even be as high as 6,300 by the end of the year. And there's some technical reasons for that. Once we get through the election, um, we just formed a cup and handle pattern technically in the markets and just broke out of that pattern. That's a fairly bullish pattern, and a target for that completion of a breakout of a cup and handle technical pattern is somewhere between 6,000 and 6,300, depending on kind of how you market and what you expect your returns are going to be. So yeah, and analysts, by the way, are all starting to migrate towards 6,000 as well. Earnings estimates are getting ratcheted up. That's going to help carry markets post-election higher in the U.S. But you got to remember, that's where all the money flows are. All the money flows in the world are primarily going into the U.S. There's just a massive flow of capital into the U.S. that is not stopping anytime soon.
Okay. I want to give a little bit of a nod to Brent Johnson, because this is part of his overall worldview through his dollar milkshake theory. It's not necessarily completely for currency reasons that it's happening, but this is part of Brent's logic if you understand his full framework. Lance, why don't we bring up the S&P chart so we can look at the current technicals? And while you're doing that, yeah, one of the questions I was going to ask was if you thought that was going to happen, melt up, or are we too overbought and there could be a material pullback? Because I think last time I checked, yesterday, it looked like we were, had blown through the Bollinger Bands, and we're trading in pretty seriously overbought territory. And I guess the two aren't mutually exclusive. We could have a short-term pullback, but then go higher by the end of the year, as you mentioned. So
Yeah,
let's dive in there.
yeah. So again, you have to separate out short-term trading versus long-term trading, and again, kind of match your duration with your portfolio, which is incredibly important. And this is where most people kind of make some of their larger mistakes investing wise. Is they go, oh, I'm a long-term investor, and they have a really short-term time frame in their portfolio, or vice versa, and those don't work out well. So you've got to manage your duration risk in your equity portfolio, just like you manage it in your bond side of your portfolio as well.
Yeah. If I could just mention, so I interviewed Ted Oakley the other day, and he had a great comment where he said, every investor will tell you that they're long-term oriented right up until they start losing money.
And that's duration mismatch. And that's what happens. If I match my duration to my portfolio, I don't care if the market goes down, as long as my duration match is fine. I know that markets are going to go up and down over time, so I don't worry, and we don't worry about our portfolios. We're allocated. If the market declines, a little bit, I don't really care. But what I'm trying to avoid is major drawdowns, and that's a different set of analysis to analyze. And we can go through some of that real quick if you want. But let's talk about what's going on technically short term, and then we can flip over and look at long term as just a couple of things, because that actually applies to a lot of assets. Gold in particular, stocks, Bitcoin, they are all in kind of the same market right now, because all assets are chasing. We're in a market where we have so much money chasing so few assets that everything is now becoming correlated again. And that's a longer term risk you've got to be really careful of, because every asset's now becoming highly correlated. All right. So first of all, we've got a couple of interesting things that are going on, kind of in the market. So first of all, over the course of the last, really since the high of July, we were forming kind of a bullish wedge here. We had rising bottoms, and market highs were kind of acting as resistance. Well, we clearly broke out of that last week. And so after the Fed rate cut, we had this huge jump on Thursday, and the market's just been kind of grinding higher ever since. We're not exceedingly overbought in terms of relative strength. The MACD is getting pretty elevated here. So again, I would suspect that upside is going to become a bit more limited, as we go forward. But again, it's not something that I would be extremely bearish about right now. There's really nothing in the market that suggests a bearish narrative for by any stretch of the imagination is warranted, at least not at this point. Um, but again, this is kind of what I was talking about. We had a very nice formation of this cup and handle. So here's your cup, and this is just a real simple technical analysis. And look, I'm just FYI, I'm not a huge technical analyst, but we just try to keep watch on certain things. So here's your cup, here's your handle. We broke out of that, and that is a bullish breakout. So again, that's very bullish for the markets. And we talked about this in October of 2022, going into 2023. We formed this on a weekly basis as well. And we wrote an article talking about why markets were back into very bullish territory and that the market correction of 2022 was over, even though there was a lot of commentary about, oh, that's just the bear market getting started. It's going to go down from here. Well, we formed a weekly cup and handle, broke out of that. And then, of course, since then, markets have been off on a tear. Now, from a weekly perspective, and if we look at that analysis from a weekly perspective, and I actually did this, in our daily market commentary that we publish on our website, I think I did this yesterday. Just let me, it's either yesterday or the day before. 1 second. Yeah, this is the weekly cup and handle pattern that we had talked about before, and we broke out of that. That on a Fibonacci extension basis, that sets the target at 6,000 by year end. So again, when we start looking at this is where the markets are starting to gravitate to. This is what they're starting to look at. These things do matter, and markets start to trade off of that, historically. Now, longer term, it's a bit different story. And if we start looking at longer term analysis on the markets and look at longer term deviations from moving averages, et cetera, you start getting a much different picture. And so, if we just look at a monthly chart of the S&P as a good example here, let me make this a little bit bigger for you, and we're just going to throw this together on the fly. Let's pull this back, say 20 years or so. You're going to notice, so here's your dot-com peak, here's your financial crisis, here's where we are currently. So on a monthly basis, what's important is what happens to markets over time. And what is important to understand is that deviations from moving averages are not sustainable long term. When you have major deviations like we have today from long-term moving averages, that's going to eventually reverse. Now, again, this is monthly. So this moves very slowly, and it could take months from now. Again, this is something that can continue to be this way for 6 months or 9 months or a year. But it is important to understand that historically, when we get very extended from long-term moving averages, you eventually get some sort of corrective process. I remember back in 2018, 2019, I was writing about this very same thing, saying, hey, we're extremely deviated from the long-term moving averages. You're going to have a correction. Then we had the COVID shutdown, right? And we came right back to the moving average. That's a 35% decline. It doesn't look like that anymore, right? This is like, well, that's 35%. It barely shows up on the chart now because we've had such big deviations now that are so outsized relative to long-term means. And we can go back 50 years as a good example of this, and we see exactly the same thing over time. Let me put this on a bit of a log scale here to make it a little bit easier to see. But you'll see over time is that every time you have these very large deviations, whether it was in 1991, you had the bear market, 1981, you had a correction. 1987 was the Black Monday, the dot-com crisis. You regularly come back and retest moving averages over time, especially from extreme deviations. And as I said earlier, everything's becoming correlated. Here's a chart of gold over the same time frame. And again, big major deviations historically from long-term means, you get corrections and consolidations back to moving averages over time. And what's interesting is again, no matter kind of what asset you look at the moment, you're seeing this same exact pattern show up on asset after asset after asset. And this is simply because of nothing else, is that it's all about money flow. And money flows are the amount of money flows coming into the US from foreign and global investors, as well as the amount of money just sloshing around in our current markets, are all chasing a fewer number of assets. Interesting stat is that in 2000 we had about 8,000 publicly traded companies. We're now down to about 4,000 because of mergers and acquisitions and going private and private equity taking companies private, et cetera. Twitter went private as an example. So we have 4,000 fewer companies for people to invest in. You have fewer asset classes in general to invest in. And so you have all this money that is just chasing assets. And when asset prices rise, it's a self-fulfilling prophecy. It just drags in more money because now I've got to chase that asset. And so I go buy, and again, one of the biggest asset classes right now that people are chasing is options, right? Because now I can leverage my bets by using the options market, using the futures market. So if gold prices are rising as an example, that drags more money into chase gold. So they buy futures because that's how you trade gold prices is with futures contracts. And that drives the price up more. So you just have this self-feeding frenzy of managers needing to put assets to work, because if they don't perform, they lose those assets. If I'm a hedge fund, I have capital, I can sit on it in cash, but if I don't get that money allocated, I lose it. If I'm private equity and I have a lot of cash to invest and I don't invest it, I lose it. So everybody's looking for something to put money in. And so it's now dragging, all these asset class correlations are now becoming one, which means that if everything's going up together, ultimately, when the market rotates, and it will, there's no place to go. So everything needs to come down at the same time.
Right. All right. So let me just try to see if I capture your general market outlook right now, which is in the immediate term, might be a little rich, right? We also have the election coming up, right? So, we might see some of the froth, a little bit of the froth come out, over the next couple of weeks. For the reasons you mentioned, though, you could see this thing running to 6,000, the S&P running to 6,000 or higher by the end of the year. But with a longer term view, given the deviations that we are above moving averages, you feel pretty confident that's going to end in tears at some point. Big question is when. It could be years away.
Yeah. It absolutely, look, at some point down the road, you're going to have a reversion to the mean. That is like the sun rising in the east, right? I just want to make sure it actually rose in the east. I had to double check my directions for a second. But yeah, every morning the sun's going to go up. And just like that, markets are going to correct back to its long-term mean at some point. It is going to happen. The question is the timing. And here's what happens for most people. And this is what's going on right now, by the way, Adam. I mean, this is exactly what's going on with gold prices. It's exactly what's going on with stock prices and Bitcoin and everything else. Is, utility stocks, real estate stocks. Everybody was sitting out of this stuff and these asset prices were rising. And they're like, oh man, I have missed out now for 3 years or 4 years, however long it's been, because I thought we were going to, everybody said we were going to have a recession and we didn't have a recession. Everybody said we were going to have this major crash and we didn't have this major crash. And now I'm not getting any, my yield is coming down on my money market. So T-bill and chill and sitting in cash, everybody can kind of see the writing on the wall of that occurring. So all that money, you're talking over $1 trillion of retail money funds sitting out there that are going to have to come back into the stock market at some point because they just want to chase yield. And so I'm going to buy dividend stocks. I'm going to buy a real estate stock. I'm going to buy utility stocks. I'm going to buy mortgage REITs, whatever it is, because I'm going to get the yield and it's going to be better than what I get out of the money market. So that flood of money coming in is going to keep pushing asset prices higher, and people are going to chase whatever's going up. So you have this literal change in psychology occurring where more and more people are going, I've been out too long, I've got to get in, and they're going to chase asset prices higher. But eventually that party ends. But again, it can be 3 years from now, it can be 5 years from now, it could be next year. And that's why we pay so much attention to technicals. That's why we pay attention to credit spreads, because when that change comes when somebody eventually holds their hand up and says, I'm out. And that starts the cascade of selling at some point, because that's how markets work. It's all supply and demand. At some point, when the buyers are no longer willing to buy and the sellers can no longer get higher prices, those prices will have to come down to bring the buyers back into the markets. And that could be substantially lower. But what causes it and when it happens, you don't know what that structure is going to be.
All right. So let me ask you a little bit about this. And I think this is an important thing to focus on for a moment for the folks that are watching here, which is, we've had a lot of guests on this channel over the past couple of years saying that we've been in an era up until recently, through 2021 at least, where the passive approach was the easy approach and it was the winning approach, right? Yep. Just the central banks, everybody had had your back. The wind was at your sails. All you had to do was stay in and buy the dip, right? But for a variety of reasons now, an active playbook looks like it's going to be required going forward for success. The old playbook isn't going to work as well. Everybody really wants the old playbook to come back, and they're cheering what's happening right now because it feels like, oh, Fed cutting again, we're back to the old playbook, right? But there are all these issues that you and I have talked about, and even more that we haven't, that are going to make things, probably more volatile going forward. And we have these massive deviations and stuff that you've talked about. So this is why I think you either have to, if you're going to manage your own money, you've really got to make the commitment to invest the time and really understanding what's going on, and figuring out, how you're going to call audibles along the way as conditions change, or find a professional who can do that for you. Because Lance is again, you do a really good job of showing us is there's short-term fluctuation in the market, and maybe, you can trade a little bit in that, but what you want to do is get your duration right and be playing to your duration goals. But then you also have to have an eye out for this big, distortion correcting at some point, this sort of Damocles that's hanging over the market that we don't know when it's going to break, right? Right. So you're smiling and nodding as I'm saying this. So what for you, what are some of the things you're going to look at? I'm going to guess credit spreads are one of them, but what are one of the things you're going to look at to say, hey, wait a minute, I'm playing my normal game here, for duration, but now I'm seeing some warning signs that might tell me, hey, it's time to maybe actually get out of the pool because I'm seeing some factors that are giving me a sense that sort of Damocles might be ready to fall.
Right. Well, again, so, from a technical basis, as a good example, what we want to see there is a breakdown in the technicals. So, we want to start looking for, and there's actually, some evidence that we may be seeing some early deterioration in the market. So if we I'll give you a good example here. And again, this is why duration is important and paying attention to things that, for instance, this is a weekly chart of the S&P 500. And let me just zoom in here a little bit so it's not but markets are rising and you have a negative, this is what's called a negative divergence in relative strength. Relative strength and momentum are actually declining. And so you have this environment where market prices are rising and relative strength and momentum are actually starting to deteriorate. And the last time we saw that was in 2021, heading into 2022. And in 2021, remember, it was all bullish. It was all good. I mean, we got money pouring out faucets at that moment. Everybody's getting checks to households. And yet, despite this continued rise in the market over that period, the underlying aspects of the markets were starting to deteriorate, and that warned us. It says, hey, and that's why we started reducing equity allocations pretty aggressively in January and February of 2022. So those are the things that we look for, and we're starting to see some of that. And so we're still a little bit cautious. We're still allocated to markets, but we are paying attention. And these negative divergences again can last a long time. You go back to 2020, 2021, you started getting negative divergences halfway through 2020, and it wasn't until 2022 before the market, finally started to reflect that reality. So again, this is, you can't say, well, Lance said this and I'm gonna go sell all my money. But no, don't do that because we're in a very bullish trend right now, just breaking out. If we get through the election and the market comes to grip with whoever gets elected and what would be the best outcome, doesn't matter who gets elected president, as long as Congress is split, you have gridlock, that's the best setup for the markets. That'll send the markets running and through the end of the year, November and December, because A, that will be a bullish setup for the markets. B, markets will want to position for the next president, whoever that is, and whatever policies they're going to have. And C, you've got 23% of all of your buybacks occur in November and December. So you have a huge flush of buybacks that occur at year end as companies want to get their buybacks done for tax reasons, et cetera, before year end. Is especially going to be the case this year if a candidate wins that starts talking about threatening to tax buybacks or anything like that for companies, raise corporate taxes, et cetera. You're going to see a big push to get things done before potential tax policy changes going into 2025. So again, there's nothing right now that really warrants a cautionary stance going into year end. 2025 may be a different story because that now we're going to have to deal with tax policy changes, political policy changes, whatever earnings, economic growth, more Fed rate cuts. If the Fed becomes more aggressive about cutting rates, they're going to be doing that in response to weakening economic growth. That's not going to be good for earnings. If earnings estimates start to come down, right now the estimates through the end of 2025 are for 18% growth rate in earnings through 2025. That's very high. So if we start to see those estimates coming down, and particularly see that combined with weaker economic growth, the markets are going to have to start to reprice to some degree for lower earnings next year. And with valuations elevated, that could be your trigger for a bit large, another 5 to 10 to 15% correction in 2025 or even 2026. But again, past about a month, predictions are pretty useless. It's just a guess at how things play out.
Right, right. Okay. You just touched on several things that I have notes here to talk to you about. I guess first with buybacks, we are currently in the blackout window for buybacks, right?
Right.
Okay. So pardon me?
Another week.
Yeah. So and then it's rolling coming out of it, right? Companies, I think it's what, 2 weeks before the end of the quarter, and then like 48 hours after they give earnings, right?
Well, yeah, and by the way, there's no rule for a blackout. By the way,
Right.
it's just
That's a rule of thumb, we'll say. Yeah, it's not a law. Yeah.
yes. So
But I just want to say that we're hitting these all-time highs in the markets during this blackout period. So to your point, when they turn on buybacks again, that should just add fuel to the bullish fire that's going on here, right?
and that again, that buyback window mostly reopens right around the end of October. And if you remember last year, this time, you and I were talking about, we were in the middle of that 10% decline in the markets. And we started talking about, that sell-off was going to end in October because of buybacks. That was one of the primary reasons. Of course, that was, October was the bottom of that decline.
Right, right. And I guess this year
buybacks, it's important.
Yeah. So this year, I'm wondering if that effect could be even enhanced if we have a decisive election, right?
Right.
So in early November, we'll hopefully, fingers crossed, know who the next president is. Hopefully, it won't be super contentious, and that should give the markets more certainty of the game book. And so you've said you expect to see the markets kind of pop anyways following an election, as they normally do, because they now know what game they're going to play going forward. That uncertainty's been removed.
That's right. Yeah.
Yeah. Okay. So you talked about earnings. Let me ask you this. While we're talking, I'll try to bring up the chart here. But the CAPE ratio, cyclically adjusted PE ratio for stocks, is near an all-time extreme. It's like 37 times right now, I think. And I'll try to bring it up in just a minute. And you've written, this is stolen from a recent piece of yours, further analysis by sentiment traders shows that when such an environment has previously existed, stocks rising with falling risk appetite typically occurred close to a short-term market correction at best and a market peak at worst.
Right.
So fancy way to say that stocks are richly valued right now, and they could be at an extreme that has potential to be a turning point, right? And I guess the question here for you is one of the reasons why stocks are trading at high PE ratios is because they expect earnings to grow a lot between now and next year, and they feel optimistic about that, and they're willing to take on more risk per unit of earnings. We talk all the time about how when we actually get to the earnings season, estimates have been marched down so that everybody can step over them, and everybody gets a trophy environment, right? But how long can you keep doing this for where the earnings end up becoming less, but the stock prices continue going up, where you just get to these ridiculous P ratios? I mean, they just can't continue forever, right?
Well, and again, this is an evolution. I actually got a email on this morning. It's like, I don't understand this. When did we start flipping over to operating earnings from GAAP? And this is ridiculous that we look at operating earnings now. We don't pay attention to the GAAP, and that really actually occurred. That's not a new thing. That actually occurred back right at the turn of the century, in late 1998, 1999. There used to be a time when you got your 10K, your annual report from the company, and in the front of the 10K, you went through all of the GAAP analysis. So that's generally accepted accounting principle reported earnings, and that's what you report to the government and everybody else for tax purposes, et cetera. In the back of the 10K would be all the operating earnings are what I hoped earnings would be. It's called pro forma earnings. This is what I hope it is if no bad stuff happens and I don't pay any employees or anything else. But this is the most optimistic view. Well, now you get a 10K, all the operating pro forma stuff is in the front of the 10K, the GAAP's in the back, right? Because now all we want to know is all the good stuff. And this has been going on for 24 years now. And the problem for investors, and this is the problem with the CAPE ratio. CAPE ratios are terrible for managing money. All CAPE ratios tell you is potentially what future returns will be over the next decade. In the short term, it tells you nothing about the markets. And a lot of this and again, the reason I wrote an article previously talking about how we've now permanently shifted valuations higher. Used to be, prior to 2000, a PE of 23 was extremely expensive and a PE of 7 was extremely cheap. And the markets traded, you can see this in your chart right there, that you just traded in that range. So if you just bought PEs when they were around 7, 8, 9, 10 times earnings and sold them at 23, you did fantastic.
Right.
But since then, we've now raised. So it used to be the average PE was around 8, 9. Now the average PE is around 15 to 17. And so we've permanently lifted valuations because of accounting changes, because of regulatory changes where, for instance, we got rid of Rule FASB 157 after the financial crisis, which was mark-to-market accounting. We never brought that back. We did that to help bail the banks out and companies out, but we never brought it back. So nobody still has to mark-to-market anymore. We've done, buybacks have become a major institution of lowering the earnings per share outstanding so we can increase earnings per share, at least at the bottom line, even though we didn't generate more revenue. So we've done all these things to increase the valuations of markets. So when you're looking at KPE and you're saying, hey, 35 is, really expensive. Well, it is expensive to the historic norm going back to 1900. It's not that expensive relative to recent norms. And it's still expensive. Don't get me wrong. It's still
I'm going to say it's the third highest reading here in the chart, but yes, it's not as expensive as it was pre-2000. Yeah. Right.
So if you just take 2000 to present and draw a median across that period, you'll see you're not that elevated above the median anymore. Not like you were from the previous median. And so we've distorted, and my point is that we've distorted markets to such a great degree that we now have to start rethinking how we use valuations as a proxy of evaluation for portfolio management going forward. But again, all valuations tell you what forward returns are going to be. So in the short term,
meaning higher valuations mean lower future returns.
Right. And so you should expect over the next decade to 2 decades that returns are going to be somewhere between 5 and 6% annualized. And that's going to literally suck compared to the 12 to 15% you've had over the last decade.
Okay. All right. And I think that that's important for folks to hear. They've certainly heard that from some other folks we've had on this channel. Certainly, John Hussman's charts, show that I think he still continues to expect a negative annual return over the next 12 years, just given current levels of valuation. But the point here is I'm trying to make is, it's a challenging environment. We have all these distortions and deformations that you mentioned. I went through what I thought was your outlook, which I think I got pretty right, which is maybe like mildly bearish in the immediate term, pretty bullish through the rest of the year, and then cautiously bullish after that with an eye out for a very bearish market correction, if these deviations that you're talking about actually really come into play here. And so, people call us as being, too bearish sometimes. And, I think you do a really good job of trying to live your mission, which is you want to be the eagle, right? It just, hey, sometimes it's bearish, sometimes it's bullish. And I'm just going to try to see, do my best assessment and be which animal it requires, in the moment. But I'm not on permanently, one side or the other, one team or the other. And so, it's just, it's rough. And let me ask you this. So, if the game has changed post 2000, do you think it'll ever revert back to the way it used to trade? Like, are we in a temporary distortion, a temporary being measured in a couple of decades? Or is this truly just the new way it's going to be from here? This is a permanent deformation.
It's a permanent deformation. And there's a lot of reasons for that. So first of all, we went from, fractional share trading to decimalization, right? So, we used to trade in eighths and quarters and halves and things. Now we trade in tenths of a penny, right? So,
right. And you can trade fractional shares too.
And you can trade fractional shares. We've changed accounting metrics. Again, we used to rely on GAAP earnings. Now we all focus, and the analysts, and when I say we, that's not me, that's we, the ubiquitous we of Wall Street. They focus on operating earnings versus GAAP trailing earnings. We've made all types of accounting changes. I did an article recently talking about, there was a study by the Wall Street Journal. The CFOs of companies openly admit that up to 10% of their reporting is completely fudging their financials to meet earnings goals because of stock-based compensation. Corporate buybacks are now a massive part of the market environment we talked about before. Since 2000, you net out retail purchases and hedge funds and mutual funds and foreign investors, you net those purchases out. Basically, those are zero. And the entire net buying of the market is all coming from corporations. So, yeah, those aren't temporary deformations. That's a permanent change. And we've also just sucked in millions of Americans now are all stock jockeys at home, on their phones, on their computers, whatever it is. I mean, look how many people are watching, this video right here, trying to figure out what to do with their portfolio, what to do with their money, right? That didn't exist pre-2000, right? I mean, pre-2000, people were like, AOL, what?
Right.
The Fed, who? Nobody knew who Greenspan was. I mean, you asked somebody on the street back then who Greenspan was. I'm like, I have no idea. Today, Ron Powell's the rock star of the market. So,
and maybe you looked at your 401k statement when it came at the end of the month. Maybe you only looked at it at the end of the quarter, right? You weren't getting stock alerts throughout the day, how everything was doing. Yeah.
Back then it was quarterly.
Yeah.
Yeah, quarterly statements, not monthly. So, so yeah, to your point, we're never going back to the way it was. The market moves faster. Again, another good example, just from a retail basis, the average holding period prior to 1980 was 6 years, is now down to less than 4 months for stocks. So when people own something, they own it for less than 4 months. So the markets move faster. They're driven by liquidity. And unless we forget the passive indexing monster that has been created since 2000, that's not changing anytime soon. And so all this money that floods into passive indexes through 401k plans, pensions, et cetera, that's just fueling, underlying asset prices as well. So those things we're never going back to an environment where fundamentals mattered as immediate as they used to. Used to back pre-2000, you could be a fundamental investor and you could do fine. You can't do that anymore. The whole market trades expensive. Costco is a great example. We love Costco. We've owned Costco for years. We will probably never sell Costco for a whole variety of reasons, but that stock's expensive. On a price to earnings growth basis, that stock is very expensive. It has been expensive for a very long time. Microsoft, Apple, Google, these stocks are very expensive. Historically, they trade at PEs that you would have never paid for back pre-2000. Today, we don't really pay attention to that much. Are they growing earnings? How fast are they growing earnings? We look at the S&P. Out of that 18% earnings growth going into next year, only 3% of that earnings growth comes from 497 other stocks. All the rest of the earnings comes from three, basically Microsoft, NVIDIA, and Google. So that's the problem we're in, and again, this can go on for years. And this isn't something that we're going to fix overnight. It certainly doesn't mean we've got to have a 50% market crash anytime soon. John Hussman's right about his returns. He looks at GDP, less inflation, looks at the growth rates, and that's how he gets to that kind of negative outlook return for the next,
12 years, but yeah.
But if you just look at, GDP growth at 2, you slap on a dividend of 2, and you look at inflation of 2, there you are, you're 5-6%, over the next decade. And that's just what you would kind of expect from stocks over time, because stocks are going to respond to inflation and economic growth, and they're going to kick off a dividend. So that's how you kind of get there. But again, as I said, the difference now, what's going to be the key difference going forward is your question. And I think that key difference is going to be the monetary interventions. We just spent a decade doing $43 trillion worth of monetary infusions, QE, HAMP, HARP, TARP, COVID bailouts, et cetera. I don't see how you do another 30 trillion over the next 10 years. It's not technically true. Another 25 trillion over the next 10 years like you did the past 10 years. So I think returns come down because of less monetary, literally just less monetary flow from interventions over the next decade. You still get that 5 to 6% annualized rate of return, and that's tricky math, by the way. That's average. You don't get average, but that's average. And that's going to feel terrible for a lot of investors that had started investing 10 years ago, and they've been getting 12 to 15% a year. I can't tell you how many people, send me emails, even your viewers. They send me emails like, okay, Lance, all I want is 10% a year. It doesn't happen, right? It happened over the last decade because of the anomaly of monetary interventions. And I think that is the one catalyst. If you strip everything else out, I think you've got to look at that one the most, because I think that's what drives asset prices over the next decade.
All right. So I literally had pulled up a chart while you were talking of money supply to ask that question, which is to say, hey, how much of this is the fact that we've had all this monetary and fiscal injection, basically since 2000? And you're saying that's probably a huge part of it. So, all right. Sorry, I'm gonna, for the interest of time, just jump to a couple of other key points before we wrap up. I had what I hope was a good rant. I'm just wondering if we're gonna have time for it, but if we don't, we'll push it to next week. So I said earlier, 2 things we want to talk about. One, you said we want to talk about bonds. I haven't forgotten about that, so we'll get there in a sec. But Japan. So Japan just elected a new prime minister last night. From when we're recording this, Lance.
Yep.
I'm killing his name here. Shigeru Ishiba.
I don't see either, so let's just go with that one. That's
okay.
Good
All
enough.
Right, good. We'll go with Ishiba for now. But apparently he was he's one of the stronger yen guys. He's not as dovish as some of the other PM candidates that was there. I haven't heard this adjective used to describe him, but kind of reading the descriptions of him, he sort of almost sounds like a little bit of a Trump type character there, where he's much more outspoken than the average Japanese politician, more willing to kind of criticize his own party and point out reforms that he thinks are needed. I think there's a bit of a populist interest in him. But anyways, he is, Japan has been had let the yen appreciate, recently, and then that ended up creating some issues with the carry trade. I think that the world was sort of waiting to see who got elected, because if one of the doves got elected, people could say, okay, good, carry trade, happy days here again. With the Shiba, is there a risk that the carry trade, which was briefly front page news and now isn't anymore, could that saga not be over here, the unwind of the yen dollar carry trade?
Yeah, no. We actually wrote an article just about that recently, talking about some of the risks that are still sitting out there. Look, economic growth is a risk, inflation is a risk, interest rates are a risk, monetary policy is a risk. The yen carry trade is a definite risk. That's $20 trillion and sitting in that yen carry trade. We resolved some of the short term leverage with the August kind of blow up, but that risk has not gone away. And if Japan lets their so again, just as a quick recap, the yen carry trade is basically a shorting of the Japanese yen through shorting Japanese JGBs, or the Japanese treasury. So I short the Japanese treasury, effectively shorting the Japanese yen. I then bring that money back into the US, buy treasuries, leverage that 10 to 1, and go buy stocks with it. So that's the carry trade. So yeah, if the yen continues to appreciate, that whole leverage setup, and a lot of that leverage has come back. Just recently we've seen, saw a big surge in the mega cap stocks, et cetera. That a lot of carry trades come back. So yeah, that's still a big risk out there.
Okay. All right. So we'll keep that as one of the things that could fray the string on the sword of Damocles going forward. But we'll see what happens there. All right. So bonds. I talked a bit about this with Michael last week, but presumably the Fed pivot, starting off with a big 50 basis point cut. I mean, yes, the Fed only controls the short end of the curve, but presumably this is something that you and Michael were expecting it to happen at some point when you took your long bond trade. What do you want folks to know this week about what's going on with bonds?
Well, we talked a couple of weeks ago when I was on with you, the fact that, and I got a lot of emails over the last week. I said, hey, bonds are extremely overbought, and this is the same conversation we were having a minute ago about the S&P 500 and gold prices and technical analysis. That when things get extremely overbought and extremely deviated from means, there's going to be a correction at some point. And so you and I were having this conversation 2 weeks ago. I said, it's too late to buy bonds. If you didn't, if you didn't buy bonds earlier, it's too late to buy them. We're going to have a correction. You'll get a better entry point. And it was interesting because the Fed cut rates and immediately bonds sold off. And I got a lot of emails from people like, I don't understand. The Fed cut rates and yields are going up and bond prices are coming down. I don't understand what's going on. It's like, technically they were just grossly overbought. We've now reversed a lot of that. We're still not there yet. I think we still have some more work to do here. But we've worked off a lot of the overbought condition that existed. We've worked off some of the previous extremes. We're retesting the kind of the 50-day moving average right now. I think potentially we could come down a little bit more. But I think 97-ish, right around there where we kind of tested the other day, gave us a much better entry point. And so we started shifting some of our T-bill and chill money into longer duration bonds, just kind of stepping up the curve. We kind of went from, 1 to 3 year treasuries to, 5 to 7 year. We're going from our 1 to 3 months, which is kind of the money market equivalents, into the 1 to 3 years. And so we're just starting to make that duration shift. But again, as we said, it's like we had to wait for a correction in bonds to occur. And, it didn't make sense to a lot of people why yields were going to come down as the Fed was cutting rates, but it was going to happen. And as I said with you, I said, I don't know what the trigger is going to be. It'll be something. It could be a hot inflation number. It could be a stronger GDP number, whatever it is. But something's going to cause those prices to correct. And that's what's happened.
Okay. All right. So super interesting. So bonds, mostly not overbought anymore, but still maybe a little bit that you're willing to come out. Did I hear you correctly that you started taking some of what was just sitting there in T-bills and moving them out a bit in duration? Not a ton. It sounded like you're taking some of the monthly T-bills and now moving them into 1 to 3 year durations. Is that what I heard correctly?
Just we've our portfolio is structured in duration, and
Yeah.
so kind of if you kind of think about a ladder, we're just kind of moving the bottom rung up to the next rung, and that rung
Right.
up to the rung, and so forth. And so as we continue this corrective process, eventually we'll get to the point that we shift some of the intermediate duration to the longer term duration. And so there's just a process we're working through over time to start to lock in, some higher yields and starting to control that duration risk within the overall portfolio. Because our duration is still shorter than the benchmark. So we're trying to now bring our benchmark, our bond portfolio duration up to the benchmark duration.
Got it. But again, just to make sure I heard clearly, because I know folks are following this closely, you've started moving some of the really short duration stuff a little more towards the intermediate. You haven't yet hit the point where you're taking your intermediate and moving it to the long, but that presumably you're expecting that may happen at some point here.
Yeah, we'll eventually get there. Eventually, yeah, we'll shift more out towards the 30-year duration. But again, we're making some other adjustments in the portfolio. Like for instance, one of the trades that we did. I don't know if Mike talked about mortgage. Did y'all discuss mortgage REITs when y'all had a conversation?
Not to my recollection now.
So one of the things that we did add almost immediately after the Fed cut rates is we added exposure to mortgage REITs in our portfolio as well through a company called Annaly Mortgage.
So you've talked about Annaly here in the past. You've talked about it in the past.
Okay. So yeah, we did that because as the Fed cuts rates and we're already starting to see refinancing activity, you had there's a great headline out of Bloomberg, a massive surge in mortgage refis since the Fed cut rates. You got to be really careful with that stuff. When you have no mortgage refis going on and you have one, it's a big surge.
It's a big percentage different. Absolutely, it's tiny. Yeah.
Exactly. So yes, there's been a huge surge in refis, but that's why. I mean, we'll see prepayment speeds pick up as rates come down. That should bode well for a mortgage REIT like Annaly Mortgage. We're going to continue to build out that position as we get opportunities. But again, and then in the actual bond portfolio, as kind of we get better opportunities, we'll start to shift more and more towards that longer duration. We already have a big chunk of long duration bonds. We'll just increase that a bit more.
Okay. All right. And folks, we'll keep tracking this with Lance week after week. So you'll be able to keep your finger on the pulse of RIA's bond strategy here. Actually, real quick, so staying on bonds. So the day we're talking, Lance, we just got the latest PCE data. And it came in a little bit lower than expectations, at 2.2%. And PCE, Powell likes to talk to PCE. Like I think he uses that more than CPI in terms of guiding policy. 2.2% is not that far away from 2.0% at this point in time, right? Yep. So I imagine that this has got to be again, validating for you and Michael there at RIA that your whole long bond strategy has been, hey, yeah, we think the Fed is going to succeed in getting inflation under control. Interest rates are a function of inflation expectations. If inflation's really getting tamed, interest rates are going to have to come down. Our long bonds are going to do really well. True?
That's very true. And I thought what was really interesting in the reports today was the personal income and spending numbers, which both came in a lot weaker than expected. So you're definitely starting to see personal incomes under pressure. They came in at 0.2 versus 0.4 expectation. Spending came in at 0.2 versus 0.3, down from 0.5 in the last report. So you're definitely starting to see some slowdown. That's going to reflect itself, into PCE itself, right? So we have PCE prices, that's personal consumption expenditure prices, but the PCE, the personal consumption expenditures report, is 70% of GDP. So again, we're really, that personal income and spending number really starts to weigh in on those inflationary pressures going forward because people are just literally running out of money.
Okay. I had a whole section here about data on increased signs of weakness in the consumer, but why don't we just take yours as the data point of the week to say that the consumers are continuing to stumble here, which is so interesting because again, you can look at the headlines and actually not just the headlines, you can look at the underlying data and continue to get real worried about the state of the consumer. But for reasons you said earlier, Lance, that doesn't necessarily mean that the stock market is going to falter, at least, for
Yeah.
the foreseeable future here, right?
Well, no, again, let's be really clear, right? I think we have to, when we say term, and in the end, you kind of pigeonholed me earlier. You talk about you got a short-term bearish view, long-term, whatever. I'm not bullish or bearish. Just it's just we're looking at data and then trying to make assessments with portfolios. And look, there's still a real risk that we could see another 5% correction between now and the end of October, right? I mean, if something weird happens with the election, it gets, there's some type of anomaly with the election, or we can't get it, verified, or there's a huge swing between House and Senate that spooks the markets. There's lots of reasons this market could sell off, 5% or so, and then we get a year-end rally, and then next year we'll figure it out. But just, right now, the markets are kind of firing on all cylinders and everything's very bullish. And there's not any reason to be bearish right now because all the technical support is in place, right? We're a little bit overbought, getting a little bit extended. So again, I think prices to the upside are somewhat kind of contained here. We may slop around here for a good bit. But if the market can hold above the breakout of these recent highs, there's no reason we just can't kind of keep grinding higher into year end.
Right. And that's so what I did, because I keep trying to channel you, and maybe I'm not doing the right job, but like you're always saying, hey, look, like don't get so wrapped up in the data and the storm clouds. Not that it's not necessarily accurate, but the market may not care in the timeline that's important to you, right? And so people can be looking at your data point and the other ones I was going to bring about consumers and say, okay, we're a 70% consumer driven economy, consumer weakening. I got to take my chips off the table because this is all going to fall apart. That actually really may be true, and it could very well likely be true. It's just those shoes might not drop for quarters from now, right? And so you've given us a good reason why the market could run. So it's like, look, if you decide to sit in safety, that's fine. It's completely your decision. Just do so knowing that you might watch the market have a party here without you. And you might be cool with that, but I'm just making sure that we're helping set people's expectations.
Yeah. And look, and this is why it's important to have a well-diversified portfolio. Again, you look at our portfolio, we're well balanced between defensive stocks and growth stocks. We've got bonds, we've got, other stuff. And, if we dig into our all-weather portfolio, we've got like 8% precious metals and other stuff in that. So, I mean, the portfolios are well balanced, they're well diversified. So, when the markets go up, they don't necessarily go up as much as the market. When markets go down, they don't go down as much as the market. And then we're trimming and hedging and raising cash at times. And we're, recently over the last, week since this breakout, we've been slowly kind of picking some spots and adding some money back into our mega caps for end of the year. Right now, they're a little bit weak here, but I think as we get ready to move into year end, companies like Amazon and Micron just had a boomer report on their earnings side. Great outlook on what's going on with AI and demand for chips. NVIDIA is going to report earnings in November, so NVIDIA's got a long time to run until November. But again, that just kind of bodes well for that whole space. So again, with the whole passive indexing flow, if the market's going to rally into year end, that's going to pull these mega caps up with it. And importantly, when the Fed is cutting rates, lower interest rates are good for growth stocks. So we have some, and then we also have our defensive positions. Look, I am really starting to like energy here a whole lot because it's been so beaten up. This is one of those sectors, kind of like, when we were buying utilities and real estate earlier this year, nobody wanted them. Now everybody wants them. Right now, everybody hates energy. Might be something to go look at, right? They pay nice dividends.
All right. So this is a good segue, trades. So
Yep.
what trades, if any, have you guys made over the past week? Pardon me?
I think I just read through them all, but yeah, go ahead.
Okay. Well, I mean, is that what the action you've taken over the past week?
Yeah. We added a smidge to our NVIDIA holding. We've sold a bunch of NVIDIA over the course of really since June and July, and so we just added a little bit. That stock had come down a lot and got underweight the portfolio, so we brought it back up to target weight. We added some JP Morgan recently. That was kind of in the finance sector. Again, lower rates are good for net interest income, net margins for banks. So we added a little bit of JP Morgan. And then, of course, we've been shifting our bond duration, like I said earlier, in our portfolio.
Got it. Okay. So you are not nibbling into more energy yet, but you're looking at it.
We've already got positions in energy, so that we really like. We own Diamondback Energy, which has been under a lot of pressures of late, and we're trying to look for a bottom in that. We're going to add to that position. We also own ExxonMobil, and that's been coming down, but we're looking for a bottom there, and we'll probably add to that position.
Okay. So yeah, when you add, you'll let us know in this trade part of the future one.
But again, this is why we maintain a diverse portfolio, because when we have a sector like energy that's been under pressure, it's a weighting in the portfolio. But utilities, and like for instance, we own GEV, which is GE Vernova, and that stock's up 49% in like 3 weeks. So whatever weakness you have, if you balance your portfolio, if you have weakness in one sector of the portfolio, you've got another sector that's pulling it up and it's holding,
Right.
holding things together. The problem with people that get all into one thing, right? I'm only in mega cap stocks, or I'm only in this thing, or I've got all my money in this thing, is that when eventually it goes wrong, and it will always go wrong at some point, you're completely exposed to that risk. And so that's why diversification and managing your risk is so very important over time.
So completely agree, and I think we hammer the diversification. Hope we hammer the diversification lesson on this channel an awful lot. But another big thing that you talk about is the gardening, the rebalancing, things like that. And so knowing when you are adding or subtracting versus just sitting on your hands is really important for folks. So, anyways, thanks for being so transparent in what you're buying and when here with us. All right, wrapping up here, I just want to close on a rant, and this isn't really a negative rant. So I bought a weighted ruck vest, so I can go out for these longer walks with some weight. It's kind of the big craze right now. If you follow the fitness influencers and longevity influencers like Peter Attia and whatnot, everybody's Andrew Huberman. They all love rucking. And so anyways, I listen, to podcasts when I go out and ruck, and I've been listening to some of the Stoicism podcasts that I like to listen to. And there's a lesson that's really just been hitting home for me, and I'm assuming it's probably one that does for you, Lance, but I wanted to get your thoughts on it. One of the Stoics, a guy named Epictetus, he said that the root of beauty is beautiful choices. Basically, his quote is, "If your choices are beautiful, so too will you be." Right? And it's basically almost kind of like you are what you eat, right? You are what you do, right? And what's I think really great about that is when you really internalize it, you can kind of reframe how you look at the world and look at your life experiences. And you begin to see that challenges aren't injuries. They're not negative things being thrown at you to make your life worse. They are opportunities for you to make beautiful choices, right? Epictetus was also the guy who said, we can't control the external events around us, but we can control our reactions to them, right? Don't get wrapped up in the things you can't control. Really focus on what you can control, which is your own reactions to them, right? And so every one of those is an opportunity to make the beautiful choice, right? And when you do that, you really start seeing life as not necessarily a bunch of adversity getting thrown at you that you have to overcome because life is hard. You start looking at it as a real gift, right? A real opportunity to get this constant stream of opportunities to make yourself hopefully just a little bit better over time as you get to address these things. And that's sort of what the Stoic experts are saying is like the Stoics, their superpower was like the more adversity you threw at them, the stronger they got, the better they got, the more they liked it, right? And it was because it kept giving them the ability to make beautiful choices, and the beautiful choices were building off each other. So they were kind of becoming more and more better and better people, all along the way. So, I know you've had to deal with a lot of adversity in your life, and Lance, I think you have preserved your sort of sense of optimism through that. We've talked about the importance of optimism. But I think you have personally benefited from, having to kind of pull yourself up by your bootstraps and not in a negative way, but say, okay, I got a challenge here. How do I make the best out of this? And I think you've done a pretty good job of making beautiful choices. What do you think?
No, I mean, it's true. And I was just having this conversation. So just a quick update on my carpenter. So he actually showed up yesterday. Finally, it's been 3 weeks, but he finally showed up to finish the work that he promised he would start. And I was actually having this conversation with him yesterday, exactly. And he's like, he says, he's like, I'm so sorry. He says, I've just had all these things hit me at one time. And, I got, kind of trapped in a depression spiral and all those type of things. And I go, look, you have to make a choice. I said, and everybody goes through this. I have had, challenges in my life and you have a choice. You can either quit or you can pick yourself up and move forward. And you have to make that choice. And, there's so many people that have so much potential, but they never go anywhere because they are stopped by fear of the challenge, right? I don't, I'm afraid of failing, or I failed and I don't want to try again because I don't want to fail again. And then they adopt a victim attitude where it's not my fault that I failed. It was because of some other event. There's always some other event out there. There's always something out there that's going to try to keep you from succeeding. The only thing that separates your success from failure is just your ability to get knocked down and keep getting up. And my dad just instilled in me to be too stupid not to get back up. And when I was fighting, it was, when I used to fight, it was exactly the same way. If I got knocked down, I knew I was probably going to lose that fight, but I would keep fighting anyway. And a lot of times I wound up winning the fight just because I refused not to quit. And that's just, you have to just kind of adopt that and realize that in order to get to success, you're going to have to go through a lot of challenges. You're going to have to go through a lot of disappointment and a lot of headaches and a lot of burden. And you're having people telling you that you're being ridiculous and you shouldn't be trying that because it's just stupid. And it doesn't matter what it is. Everybody's got their opinion, and you just have to ignore it. And then just continue to move forward with whatever your goal is going to be. And every goal is achievable. You just got to be willing to adapt. And maybe, and this is one thing that happened to me along the way, is that my end goal changed. And in the process of trying to meet my original goal, I realized that my original goal wasn't really what I wanted. And, what I wanted was something different. And so when I started out, I was building health and fitness facilities like Gold's Gym or 24-hour fitness. We were building these big, 20,000, 16,000 square foot fitness facilities. And I was all big into physical fitness and training, and I was certified to be a personal trainer, and that's what I wanted to do with my life. And along the way, what I figured out is that I like dealing with the money aspect more than the actual gym
Gym
aspect.
aspect. Yeah.
I like the raising the capital, dealing with the finance people, managing the investments. And so again, in that path of trying to get to my goal, I figured out that my goal was actually different and what I wanted was different. And so I changed and I started
Right.
working.
And that's an example of a beautiful choice, right?
Yeah.
The choice you made was, I can keep doing this, but I'm realizing that this might not actually be the path I really want to be on. There's a better one over here. Let me make that shift, right?
And same thing, I mean, with when you left the other place to do this, you had to make the choice to do it all on your own. And that's a choice you had to make. And that was just that.
Absolutely. I'm glad you brought that up because it's a really important example of this next part that's been really important lesson from the Stoics. I think we've talked about it a little bit in the past, but it's the obstacle is the way, right? Which is, as you said, the universe is going to throw a lot of things in front of you, and if you adopt the victim mentality, or you see challenge as just painful adversity, you'll spend a lot of your time either just sitting, being blocked by the obstacle, or just trying to think of shortcuts around it or things like that, rather than addressing the root issue and just getting past it, right? And for me, it was making that jump, was addressing an obstacle that felt like a pretty big mountain in front of me, and finally realizing, hey, the way through this is literally to just climb this damn mountain and get to the other side of it. And it unlocked a ton of opportunity. And I couldn't be more thrilled about how things are going with Thoughtful Money here. And so, to your point about just, getting up, not shying away, not getting deflated. It's seeing these, what you start shifting is from, oh, there are all these obstacles, I got to go a different direction, to seeking out obstacles and saying, hey, what is limiting me right now? And let me go after that head on, because the more I do that, the more limits I'm removing from my path, and life's getting so much better and I'm able to do so much more, right? You actually start hoping to see some of these obstacles because you know that there's a better outcome on the other side of it. And the last thing I want to say about this is uh, uh, Stoics, they kind of have this reputation of being these really like stern, sour people, right? But they were optimists. They basically said, look, yes, you should be smart and you should think about what could go wrong, right? And come up with a plan for it in case it does, but then forget about it. Like, focus on what's possible, right? And there's a great quote from Seneca, which is, a man who suffers before it is necessary suffers more than is necessary, right? So if you spend your time sitting in the fear hole, worrying about something that happens, I mean, if it doesn't happen, you've just suffered a lot for nothing that materialized. And even if it does, you may have spent a lot more of your time suffering than you needed to. Like, a lot of times the actual injury isn't as bad as you thought it was, and you eventually figure out a way to get over it. It's another obstacle that you figure out how to overcome and you get on with life, right? And I think, you're a good reminder for investors of like, hey, if you're worried about, a massive market crash, or, a horrible recession, a depression or whatever, yes, those things might happen. And it's important to have a plan in place if they do. But if you worry too much about it, you're like the people you talk about who got out of the market in 2008 and are still trying to find their entry point back in, whatever it is, 15 years later at this point?
Yeah. But that's the same thing, and again, it's like, when I talk to young people, and look, this is the one thing, if you're younger and you're listening to this podcast, the best thing you can do for yourself is go find a mentor. Find somebody who is successful, somebody who it doesn't have to be in the same thing that you want to do, but just somebody that's been successful, somebody that you can talk to. Don't bug them, right? Don't, be on their heels every single day, but form a relationship with somebody who is successful. Don't ask them for anything. Don't, try to get a job with them. Don't do any of that, right? Just introduce yourself, say, look, I really respect what you do. Compliment. Everybody loves it, because everybody loves to talk about themselves, right? And
exactly.
Could you just, 2 minutes,
Right.
can I buy you a cup of coffee and just spend 2 minutes with me? Just tell me how you got here. And, and if you're not a burden, people will open up. And again, it's like I was talking to my cabinet maker guy, yesterday, and saying, look, there's all these things, these challenges we run into. And I gave him some of the lessons that I learned from my mentor, who taught me how to deal with adversity. And because you run into these challenges, and there's some things you just can't do anything about today. And he taught me, he says, you've got to put these issues into boxes mentally and say, okay, is this something I can deal with today? Can I solve this problem today? And if the answer is no, you put it up on a shelf and you forget about it and you move on to whatever else you can do today. Eventually, the solution to that problem on the shelf will manifest itself. And then you can solve that problem, whatever it is. But but what happens for most people is they get so wrapped up in that problem they can't solve today, that they spend all their time solving an insolvable problem and they get nothing else done, and they
Right.
literally stop in their path. So a good mentor will keep you from doing that. And look, that same lesson applies to the markets. It applies to investing, to starting your own business, to family members, to relationships. All these things are the same, and you just have to have an approach to deal with problems, communicate well, resolve issues quickly, and move forward. And the one thing where people fail, and I have a family member that's been a complete failure his whole life. He had a bad marriage early on in life. When he was in his 20s, his wife left him, and he never recovered. That relationship broke him, and he never had a relationship with anybody else for the next 40 years. And he lives alone and works a very minor job with no risk, because he's afraid that if he reaches out and tries to move forward, somebody's going to hurt him. He's got this idea that everybody in the world is out to hurt him personally. So he will take no risk to be hurt, but you can't move forward unless you're willing to be hurt. You can't move forward unless you're willing to lose. You can't move forward. You can't invest money unless you're willing to lose money. And that's the whole lesson you have to learn from this.
So I have definitely had a family member and still kind of have one that is affected by exactly that. And that is the opposite of what we were talking about, of the obstacle is the way, right? They let the obstacle become the end of the road for them,
Yep.
right? Where we are saying, look, once you learn the obstacle is the doorway, you just have such a better life than somebody who lets the obstacles stop them. You made me think of one thing, which I'll make the ending comment here, but I totally agree with everything you said about advice for young people, and I would add two more things. The Stoics said you only become successful at Stoicism once you learn to talk with the dead, and basically what that means is, once you start actually going back and listening to other philosophies and building off of the wisdom of others, that's when you begin to become successful at building knowledge that helps make your life better, because you're basically, learning all the lessons of those who came before you, and you're starting from a better starting point than they did. So that's exactly what you're talking about with reaching out to that mentor. I would say, because I give the same advice to my kids, is make your superpower informational interviewing. Like anybody who's doing anything remotely of interest to you, or you think has some knowledge that you could benefit from, ask them for that 2-minute chat. Take them for coffee for 5 minutes. People love to be helpful, especially if it doesn't come with a huge ask. They love to talk about themselves and their work, right? You will get 9 times out of 10, probably even more, an absolute yes. I'd be happy to do that with you. To your point about like a mentor, I totally agree. And I would encourage people to think broader than that, which is, every company or every major company has a board of directors, and their job essentially is to help the CEO make the best decisions that he can. Recruit your own personal board of advisors. And again, these are people, don't call them up every day and ask them to help you micromanage your decision making, but just say, hey, once a month or so, would you mind if I call you up and just kind of give you a report on how I'm doing, and get any counsel you might have for me, or if I've got a question I'm wrestling through, I'd love to get your input on it. Can I give you a call every once in a while? Be selective of who you ask to do that. But if you get, 4 or 5 people who are successful in the areas of life that you want to become successful at, to agree to do that, and most people will, as long as you don't abuse, their graciousness there. Again, it's a massive catalyst towards success. And I know when you're younger, you feel like, oh, I can't possibly bother those people. People love to be asked. The worst thing you're going to hear from somebody is, hey, I'd love to help, but I can't. Sorry, right? And you just go on to the next person, right?
Yeah, the thing not to do, and again, in this process, don't ask them for something. It's okay to ask them for advice, but don't ask them for a job. Don't ask them for money.
Absolutely.
Don't for an investment into your business. Don't ask them for anything. Let them help you. Ask them for, say, hey, could you, I'm trying to start this business, and you've been very successful. Can I borrow 5 minutes of your time? And build that relationship just to let them kind of look over your shoulder. If you become successful, they will offer to invest in your business. If you're doing what is you're creating a good business, you're building a good business, any person out there with money is going to go, that's an opportunity I like to be a part of. And I have people ask me all the time, like, hey, can we invest in your business? No, because you have to be registered. But, people see the success that we built in our business, and so they want to be part of that. But if you go to somebody saying, hey, I'm trying to start this business, will you give me money? That's an immediate shutdown.
Absolutely.
Money get approached. Everybody is out there trying to hustle money. So it's almost an immediate shutdown. And so that's not the right way to start that conversation.
Absolutely agree. Okay. Well, look, we'll wrap it up on that. Folks, if the best decision that you feel you make, if the most beautiful choice you feel you can make going forward to improve your life is to listen to Lance Roberts on this channel week after week, please let me know that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Reminder, if you want some help in terms of thinking through how to navigate the road ahead, you know, the ups, the downs, the swords of Damocles, et cetera, and you'd like to talk to one of the financial advisors endorsed by Thoughtful Money, you can do that just by filling out the short form at thoughtfulmoney.com. Only takes you a couple seconds. Perhaps the firm, if it's Lance's and his firms that you want to talk to, if you fill out that form, they'll be in touch with you, you know, within 24 hours or less. Last, just a reminder that our conference is now coming up pretty fast. Our online fall conference is Saturday, October 19th. If you can't watch live, replay videos will be sent to everybody who registers. And a reminder that the early bird lowest price discount that we're offering expires at midnight on Sunday. So this video is launching Saturday morning. If you haven't signed up yet, you only have a little bit less than 48 hours to lock that in. So go do so by going to thoughtfulmoney.com/conference. And a reminder, if you're a premium subscriber to our Substack, you get an additional $50 off of that ticket price. All right, Lance, thanks so much for, again, yet another week. Look forward to your update next week. And in between now and then, I just wish you a lot of beautiful choices.
Thanks a lot. I appreciate it.
All right, buddy. Everybody else, thanks so much for watching.